Hello ladies and gentlemen, and welcome to Common Basic Things. My name is Cruz, and today I'm going to show you how you can do put credit spreads, right? Now before I do start, keep in mind that I'm not a financial advisor nor a licensed professional. If you'd like to invest in the stock market, please consult with one first. These videos are strictly for entertainment purposes only. Please do not try what I'm about to show you guys. And if you'd like to invest in the stock market, invest at your own risk. Secondly, please smash that like button and subscribe. Sometimes it takes me hours to make these videos, so any like or comment is really appreciated. So let's get right into it, guys. Let's start with the stocks that we're going to be talking about, calls and puts, and put credit spreads in particularly. So now, most people, if you don't have the, of course, the funds to just sell and buy calls, or sell and buy puts, then there's different alternatives that you can actually use, um, like a poor man's puts and calls. So now to show you an example of that, I don't know if you watched the video before, you do have to have options trading enabled. You do have to go to your account right on top. When you click onto the top right, you go into settings, and when you go into settings, you go into options trading. It'll take you right over here. Now, in options trading, you'll see the option here to enable it. Now, depending on what level you are, in order to do spreads, which is what I'm about to show you, you do have to have a level 3 account. Now, honestly, depending on how long you've had your Robinhood account for, or if you've already bought calls, bought puts, sold calls, then you might not have this yet. You might need to level up, but usually it just takes the basic things like buying stocks, selling stocks. Like I said, I'm not sure if that's what you require, but you do need a level 3 account. Once you do have a level 3 account, you can do spreads, which is what I'm about to show you right now. Now, in order to do this, you do have to go into I would say a stock that you don't see but more of an uphill trend to. So like, for example, let's go to triple Q. Now personally, I would think you'd have to have a bullish opinion on the stock, because you want it to have an uphill trend, which in a put credit spread, that's really what you're gonna benefit from. So now let me show you an example. So when you have the options trading available, once you've already enabled it, what you're gonna want to do is, depending on what day you want it, the contract to expire. These are the days right here. Let's say we want to do the 11th of September, so 2 weeks away, pretty much. So let's say, for example, we're doing puts today, not calls. I can do calls in another day in another video, but let's say puts, for example. Now, when you're selling a put, you're getting a credit, right? But what this means is, if by any chance the stock price, the share price goes below your strike price, the 291, then you're gonna on the expiration date, then you're gonna be forced to execute this, or you're gonna be forced to execute this, which means you're gonna be forced to buy triple Q at a 291 strike price. Now keep in mind that you are getting 516 per share, which in the contract's 100, so $516 for the contract itself. But you are gonna have to have $291 times 100, which is pretty much around like 30K. And that's a lot of money right there. So it is a lot of collateral that you're gonna have to have for only a small return, unless you have that amount of money, of course. By all means, if you do it weekly, monthly, and you continue the wheel cycle, you'd be looking to make a steady 2,000 a month, if you just continue the wheel cycle, if you had that much amount of money just hanging. But if you don't, like me, like myself, then what you want to do is poor man's puts and calls. So now what that basically means is, instead of what that means is, instead of having that amount times 100, the contract, so like 30,000, collateral that you'd have to have here in this contract. What you can do is you can do the opposite of what you're doing right now, which instead of selling a put, you'd be buying a put. Now what this does is it minimizes the risk that you would have if the stock was to by any chance go all the way down to zero. So you wouldn't need that much collateral, and it would take that amount. It would be less amount that you'd have to put as collateral. So let me show you this. Right. So let me show you this example. So we chose the strike price of $291, right? So we would have to have $29,000 basically, just as collateral. But we'd only be getting like a 516 return, which is not bad. Don't get me wrong, but what we can do is we can minimize the risk, but still get a profitable return. Now it's gonna minimize the return, too. Of course, you're not gonna be getting the 516, but let's say we were to choose this one right here. Now the total credit would be 76, right? 76 in the contract. Let's say we were to do 1, 2. However many contracts you want to do, but we're just going to do one, right? So 76 times 100, you'd be getting $76. And the risk that the collateral that you'd be putting would be the difference of the strike price times 100, basically. So now this, for example, is $2. So the risk right here would be 200, right? But not just that. Now there's Now you do keep in mind that you are getting a credit for this right over here. So the credit that you'd be getting is around $76. So let's see. So now let's review this order. As you can see here, the collateral would be 200. Now, keep in mind that if you were to subtract the credit you'd be getting minus that collateral, then the maximum risk would be around 124 instead of the whole 200. But what this means is, if by any chance triple Q was to drop anywhere below the 291, then you start seeing that collateral start chipping away. But if it was to drop all the way down to 289, like 288, anywhere below, then your maximum risk, if it was to drop that much, would be only 200 and not any more than that. And that's the good thing about a spread. It minimizes the profit, but it also minimizes the risk and the collateral. And I mean, if you're just starting out, if you don't have a level 3 account yet, just keep doing it consistently, every other day. Just invest some money, buy stocks, just do a couple things there and then and there. Just don't go crazy or anything like that, because there are rules and restrictions that you do have to take into consideration, or else something could happen to your account. But yeah, I mean, here recently I was able to start doing spreads. I wasn't able to till maybe a month, maybe a little bit longer. I'm not sure, honestly. But I mean, I've had this account for over 2 years now. Now you do also have to keep in mind that you want to choose a stock that's not gonna be too volatile, that's gonna go up and down crazy. Also, depending on how much in the money you want to be in, personally, I wouldn't choose like too close to the share price. Just if you want to be on the safe side and not have to really, lose your collateral. If you really don't want to do that, you can choose some out of the money. The only thing is, like I said, the profit is going to be much less. So like, for example, so let's say we were to choose this one right over here, 286, right? Now the credit would be 347, right? But there's a lot of collateral. So let's go back right over here, and you can choose one right under. The closer they are to each other, the less collateral that it most likely asks you. But also the return wouldn't be as much. But like I said, you do have to do your own research and make sure that nothing, or whatever stock you're choosing from, is a stock that's, you have to have a bullish opinion on that stock. You have to be thinking and do your research on the stock. Make sure that it has an uphill trend. You don't want to choose a bad stock and lose all your money. It is a profitable way of making a extra having an extra source of income, but you do have to keep in mind that it is also risky. Stocks, they fluctuate very, very much. But now let me show you. So let's say we were to choose this one right over here, the 286, and let's say we were to choose the one right below it. Well, the minimum credit would only be 27, right? The collateral would most likely be the difference, 100 minus the 27, which on that one it'd come out to be like around maybe like I think 73. But if we were to review this, the collateral, as you see, just 100. Now you can choose a bigger difference on the strike price if you'd like, but like I said, just you have to be careful because you do most likely would need, like as you can see right here, the credit right over here would be 96 instead of only the 27, but the collateral would be around 400 right up, so you can see. So that's the main difference. It'd be the 400 minus 96, which would be like around 304. So that'd be really the collateral. But like I said, also keep in mind that you do have to have level 3 enabled. You just have to do the basic things. Just start with something that you just can get comfortable into doing. Don't you have to, if you're just selling puts, you have to be comfortable with the stock that you're choosing, because if you're selling a put, the price does go down, you do have to buy it. There are different types of spreads that you can do. There's put credit spreads, there's put debit spreads, call credit spreads, call debit spreads. It just basically changes your opinion on the stock, if you have a bullish opinion or if you have a bearish opinion. So other things that you have to take into consideration, you can make a lot more money if you're just selling and buying puts and calls, right? But if you're selling a call, you do have to have 100 times that share to sell a call. But you can get a lot of profit from just doing that if you do have 100 stocks already, or if you're thinking about getting into the stock market and just wanting an extra source of income, and you just want to buy a stock that also gives you dividends as well, which also that's also what I'm trying to do here. That's how I'm trying to try and grow this account, is with dividends and with trading, just buying, just being consistent. Not just looking at the downs. Whenever you see red, that's when you want to try and invest more into it. But yeah, any red day is it's a okay day to me. You have to have a good risk tolerance, but you also do have to be careful and take a lot other things into consideration before you do that. But if you were to be selling calls, like for example, if you did have 100 shares of triple Q and you did want to just sell a call, just think, if you already had 100 shares, or if you wanted to buy 100 shares of something, or you do, what you could just be doing is selling calls right over here. For example, let's say you want to choose, we can choose one closer, right? Now, if you didn't want to sell the stock, like if you really don't want to get rid of your stock, and you want to be more on the safe side, choose something out of the money, something that's not too super realistic to where you wouldn't be uncomfortable selling your stock at that price. So like for example, this one, if you had 100 shares of triple Q, if you were to sell this one, you'd be getting $100, but they would be taking your 100 shares as collateral. And for example, even if you did buy your stocks at 290, right, and you had to sell at 300, you're still making $10 profit on top of the credit that you're getting here, the $110 that you'd be getting here on top of that. So you'd be making around 1,110, and that's a lot of money. If you did have to sell it, but you don't have to. Depending on how the stock is trending, you can always exit out early if you don't want to get rid of your stocks, or if it's going the opposite way of what you wanted it to do, anything like that. But yeah, you can sell calls. As long as the share price doesn't go, as long as the share price doesn't go above the strike price for the call, then I mean you'd be keeping that 100 shares that you already have, and you'd just be getting $110 for free basically, for just just putting your stocks out there. And like I said, if you didn't really want to sell it, you could always close out early. You just have to pay attention. But yeah, I mean that's really all I have today here for you guys. I haven't been doing much here lately. Um, I do have a couple more plays going on that I am hoping I can capitalize on. This one I didn't do too great on it. I bought it at 315 altogether. Right now I'm at a negative, but these past 2 months I've actually been selling calls on it. And as you can see right here, I'm selling this one right over here of 135. So I mean, even if it by any chance does go up above 250 and I have to sell it, well, I've already gotten a profit from the other ones that I've sold before, and I'll be getting another one whenever this one expires. And I mean, even if it was to sell at 250, which I bought at 315, I'd still be breaking even even if it sells at 250, because I've already made a profit from selling the calls. And that's what you have to be aware of. Even if you make a bad mistake, or not a great one, then you can always try and better it. Of course you don't just want to keep it there, because it's going to lose more value. Like right now it's not doing too great, but as long as this stays the same, I can keep selling calls on it, and calls after calls and after calls, and I can make, if not what I already lost, more on top of that. And that's what you have to keep an eye out. You do want to stay positive all the way around. You don't want to just look at whenever you go down, because I mean I was down a lot of times, um, a lot more than I've liked to. But you live, you learn. You keep losing, eventually you'll win, I hope. And yeah, so far I've been doing okay. At one point it was doing pretty great, but then kind of went down. Yeah. So yeah, you live, you learn. Because right now also money's that with inflation going on, money is depreciating in value, and you don't want to just keep your money in a savings account. Whenever you can let your money ride the prices going up on the stocks as well. So that way it kind of levels, doesn't depreciate. Because if you think about it, like with inflation going on, most likely, like if I'm mistaken, your $100 today would be worth around $98 next year. And that's a $2 difference. And imagine if you have more than that in your savings account or something like that. Well, that's also losing value. And I mean, that's not, unless you have a high interest savings account, which really any savings account right now isn't really high interest. Um, but I mean, that'd be better than just having it in a no interest savings account. A lot better than that. But yeah, that's here what I've been doing recently. I'm trying to get AT&T to 100 stocks, so that way I can start selling calls on it too. I'm about to get there. I've just kind of been slacking a little. I made a couple plays that didn't work out too great, but uh, kind of evened out. Not too great of a week. It's been an okay week. Um, but yeah, that's really all I've been doing. Trying to grow this account to a dividends account, so that way I can just keep reinvesting the dividends that I'd be getting, and just keep growing this account and growing it until one day we can let our money work for us instead of us working for our money. So yeah, that's really it, guys. And that's all I have for you guys today. Again, thanks for watching. Let me know if you have any questions or anything down in the comments below, and I'll see you guys next time.